According to our speaker, actions in Washington, D.C. can be a powerful leading indicator for investment returns. Policy disruption occurs when changing legislation and regulation alter industry dynamics, company business models, and global economics. Ben Phillips, CFA, is the Chief Investment Officer at EventShares, host of the podcast 10 Minutes, 10 Answers, and Managing Director and Chief Investment Strategist at the brand new market insights provider, Market Desk Research. Please welcome Ben Phillips.
Thanks, John. I am mic'd up. I tend to talk loud, but we're here. So I want to start off just with a quick couple of questions. One, who here dislikes politics? Politics, show of hands. I personally do a little bit too. And then second question, who in here made a change, whether in their personal account or a client's account or institutional account, after Trump was elected, based on something like tax reform, financial deregulation? Anybody in here make any changes in portfolios? So a few. So right there, that shows that there's already people in the room who understand there's a difference between policy and politics. And that's what I really want to drill home today. It's whether you're talking to clients or whether you're just thinking about investing, it's really important to separate out that political noise with policy. And I'll touch on this a few more times in a few different ways. But so, like John said, I'm Ben Phillips, Chief Investment Officer at EventShares. We are a government policy-based investment firm. So we put out research and we manage PLCY, which is the government U.S. Policy Alpha ETF. The name is actually changing to U.S. Legislative Opportunities ETF next week. That's an ETF. It's 85 basis points. That's dropping to 75 next week on the expense ratio. But that's our business. And what we've found, though, was investors really like our insights on policy because we share what we're doing in portfolios and why, and we also publish research. And that's where the market desk came from, was people were saying, I love your policy work. Can you broaden this out to broad market idea generation? And that's what we did. So I'll touch on a few of those key reports at the end, too, just so you can see some of the work we're doing, if that's helpful for you. But so a quick story about how we came about. My partner and I were both at Goldman Sachs. I was at GSAM on the asset management side of the business, managing portfolio, multi-sector, total return portfolio in fixed income. And my partner was on GIR, Global Investment Research, and he was covering large cap financials. But he came to me in March 2016 and said, Ben, 80% of my client calls, these are hedge funds, institutional investors, big money, smart money, are coming to me and saying, what's going to happen to defense spending if Hillary gets elected, or what's going to happen to healthcare if Trump gets elected? What does tax reform mean for my sectors? How should I think about that and the implications on profitability? And we started talking about it and realized that Goldman wasn't answering these questions well, then there was an opportunity there for someone to provide some thought leadership. And that's where the idea came about. And you fast forward 2 years ago, we launched the first ever government policy-based funds in the world, and that's what we're managing today. So we are thought leaders in the space. We quickly kind of locked down that. You may be familiar with Strategas. We're kind of similar to them, although we're actually putting ideas even to the single stock level out there for you. Our clients are typically financial advisors, RIAs, family offices, institutional investors to a lesser extent. But I think with market desks, there's more and more institutional interest in the research. And then all of the policy work is on our website at eventshares.com. So if you want to see any of those free reports, they're all out there for you to use. A couple of sector deep dives, a lot of information on that library. So today we'll talk about just separating politics from policy and what exactly that means. We're going to talk more about just the market outlook post midterms, and I know that was almost a year ago, it was 10 months ago, but really interesting to see some of the historical reactions in markets after midterms and how we're pretty much following that today. Then we'll talk about policy catalysts, really look at 9 different examples, and I threw a 10th one on there just as a bonus because it's weird to have 9. And then we're going to look at just the investment case, so just different policy disruption, what to look for 2020 as the last piece. So really look at that outlook, and then we'll look at some of the market desk things that can help just broader investment idea generation. So politics is really that conflict. It's the debate. It's the jockeying to get something done. But at the end of the day, it rarely results in policy. And so where we spend a lot of our time is looking at where there's actually a policy inflection or a policy trend occurring. And that's what we like to call out. We're not necessarily speculating and saying this is going to happen. What we're doing is saying this is happening, and this is where we think it's going to impact different subsectors and even single companies. And so that's where policy matters. It actually impacts companies down to this economic level. So really our investment philosophy is really looking at Washington because we think it creates investment opportunities. And I think a lot of people look and you hear political risk. You hear that all the time. I'm sure people in this room hear political risk constantly these days. And what we want people to think about is that risk, truly, you know this, as CFA charter holders, most of you, risk swings both ways. So we kind of flip it on its head. As opposed to saying, political risk, we say policy opportunity, right? We look at this as a long-term leading indicator for changes to companies and changes to industries. And so if you look at policy at that approach, it could be a negative leading indicator, but it could also be a positive leading indicator. So just keep in mind there are these tailwinds, and that's where we're investing and trying to help investors position is in those long-term positive tailwinds coming from policy action. And so we'll touch on some of those. And do feel free to interrupt me on any of these. I tend to fly, and I like the interruption. And so if you have any questions, especially once I start getting the policies, yeah, there we go. Yay, please.
Defining policy as legislation. Here over the last few administrations, I've seen less legislation through Congress and more going through executive action. Is that what you perceive as well, and how does that come into play?
Yeah.
All things are based on the present period, not legislation.
Yeah, so the question is legislation kind of all we look at, really, and we're looking at policy outside of Congress now occurring a lot more frequently. So I agree with that thesis. We are observing that. And we start to pick up with the Obama administration, where he was using a lot more executive action to affect policy. And where we saw with Trump was what he has done is installed a lot of different heads of various agencies. And the agencies, which I think people fail to realize this, the agencies are where the meat of regulation and lawmaking occur. So Congress passes a bill, but then after that, it's the rules-making process that actually implements that law. And it's the same thing once you put somebody in charge of the CFPB, and they go in and just start slashing regulation in there, that's an agency head who is really mandated by the president to go in and do whatever the president's mission is. But so that's the big area we're seeing it for the Trump administration is the agencies. And I'm going to talk to a few examples later in the presentation, but it was, very timely question because, what I talk about here is these agencies issue 3,800 rules every year. And these rules are again, it's the meat of law. It's where you're actually saying, okay, this is the framework, because what really a bill passing Congress is just a framework, but the rules-making process, which you talk about draft rules, proposed rules, amended rules, final rules, that's where you're talking about law actually being created and the true legality behind everything. So just kind of backing up, because I'm going to touch on that again in another slide or two, and then we're going to look at specific examples where agencies have impacted policy and impacted sectors because of agency actions. You can think like FDA, EPA, FCC, even the SEC and the OCC have those impacts. But the biggest thing is, and we saw it with tax reform, U.S. policy impacts every company who does business in the U.S. or with the U.S. And so it's a really critical component to look at in building any investment thesis, in my view. And again, I always saw it, whether I was at Lord Abbott or Providence or Goldman, that people were looking at policy as a risk. And they were thinking it was always just listed as a risk factor, usually in the negatives, right, the concerns. And again, we're trying to flip it on its head. So you say, let's look at policy and look at the implications, because it could have positive implications. And that can be really powerful because you can pick up a multi-year trend. Washington's complex, so our big value add is helping you look through that noise. There's a lot of noise out there. You open up any newspaper, it's mostly noise. And so we're trying to cut through that for you, help you look at where there's actually winners and losers. And again, the abundant opportunities. Congress is passing typically 750 plus bills per year on average since the post-war period. Supreme Court ruling on 130 cases, and the agencies, again, I mentioned, are 3,800 rules per year typically. And then the last piece is there's actually Harvard research by Dr. Lauren Cohen, who we're close with. His report that he published over a 20-year period, they generated 11% alpha per year through a market-neutral long-short. And they were just going long 5 sectors, short 5 sectors based on policy trends. And that's a really fascinating. You can just read the abstract and get a sense for what they did there. But that just gives a little academic support for what we're doing. So, the question earlier about just congressional actions, these are the 4 main areas, and you'll notice we don't have the White House on here, and really it's because where the White House affects change is through the agencies or through kind of congressional bill signing, right? And so these are the kind of the four areas we look at: judicial, obviously, Supreme Court, but even the district court levels and the state courts. Congressional, House and Senate committees are really important for us as far as seeing where there's a potential policy trend, the starting point. The agencies I mentioned, these are, heads of these agencies are tasked with various, goals set by the administration typically. And then states are really important, whether we're talking about state infrastructure, cannabis legalization, sports betting. We have a lot of state initiatives in the portfolio or plays on a state initiative. And we'll talk more about that too. We're not invested in cannabis, just to forewarn you. We're pretty negative on it. But so this is just some historical markets post-midterms. Again, I think it's fascinating to look at, and I think a lot of CFA charter holders in here, so we'll take this with a grain of salt because I think the sample size is 23. We'll see on the next slide. I think it's 23. But post-war period, midterm elections, typically a strong stock market after midterms, and it's because you get a little clarity, you get the policy, uncertainty moved out of the way, and people are focused on the next couple of years. And also, the third year of a president's presidency, the third year, has been the best market performance in the third year. And we've seen that, historically, whether it's Republican, Democrat, typically a little better under Republican in the third year. But this was the really interesting thing, I thought. On the far right side, you see 3 months after midterm elections, 6 months after, and 12 months. And this is midterm elections in the dark blue. But what you normally see is you see this rally, and it's about evenly split between the first 3 months and the next 3 months. But then you see the market pretty much flatline after that. We've seen that same thing since midterms. We saw a pretty good rip rally at the beginning of the year after a real rough Q4, obviously. And then we saw that continue really into Q2. And then markets really haven't done much. There's been volatility in August. We've seen kind of markets just kind of holding there. So it's interesting to see that this was pretty similar performance that we've seen post-midterm periods in the post-war period. So this is looking at gridlock, and you hear a lot of people say gridlock's good. There's a whole congressional effect study out there that is saying the days that Congress are in office is bad for the S&P, or days that they're out of office is good for the S&P. And there was a gentleman who we've worked with a little bit who studied that and actually had a strategy on that that's no longer around because it just didn't end up working like kind of in the way it was implemented. But it's fascinating that people think that gridlock is good. It's really not necessarily good. What we see is when you have full control. And again, limited sample. There's only 8 samples, or a sample size of 8 for Republican and Democratic control because we're looking at kind of post-1935. But that said, even with the limited sample, it does have some indicative power that we say, full control is good. I think the market likes certainty, and we've seen that even just in the Trump administration, but the market likes policy certainty. And so when there's, a full control situation, that's when you typically see the best market performance. And again, I think what it's all going to come down to is kind of the macro, right? We're late in the cycle here. We have okay GDP growth or decent GDP growth, maybe hindered a little bit by trade. But at the end of the day, it's going to come down to, we think, macro. But it is interesting to see that even the macro is typically better under full control versus gridlock. So just interesting, fun facts there. So what's working in 2019? We're kind of getting late in Q3 here. And I wanted to show some examples of what's worked year to date from a policy theme investing basis, because these are ones that we called out, really late last year, and they've materialized and played out. So a few like defense spending. We'll talk about that. Recession-proof, maybe not. Recession-resistant, yes. And we'll talk about why. U.S. infrastructure spending, we put the odds at 100%. It's a little tongue-in-cheek, but the states are spending. It's not a federal bill. Everyone's talking, well, there's no federal bill. That doesn't matter. The states are spending $80 billion more per year, and that number's growing double digits this year. Cannabis legalization, we're going to talk about that. We're skeptical of that being a good investment opportunity. Yes, there's a lot of policy trend there that's probably favorable for certain people, but overall, from an investment standpoint, very tough to make money there, we think, private or public. And then sales tax compliant. We're going to talk about how there's a single stock opportunity that was created by a policy change. It's really unique, and we'll talk about that one. So just on defense spending, this is something I think people in this room have probably seen the studies over Republican administration, Democratic administration. There's usually higher spending under Republicans, right? And you can pull up a chart, again, post-war, and see that it usually builds during Republican administration. You see a drawdown during Democrat. But the other thing to point out too is even in that scenario, there's still kind of off-cycle growth that occurs, and it's because defense spending is cyclical but over its own cycle, so it's away from the market cycle. And so this chart is looking at defense spending growth in dark blue, S&P sales growth in the gray. So you can think of it as sales growth of the defense industry versus sales growth of the whole S&P. And you see that the blue line is kind of the delta between the two, the difference. And you can see that it kind of goes through its own progression here. And that's where it adds diversification. That's why we like defense. It kind of always belongs in a policy portfolio in some way, we think. But generally probably be larger during a Republican administration, smaller during Democrat. So 2018 was volatile for defense, right? We had Mattis resigning. We had the Syria troop withdrawal that kind of was concurrent. And then we had the Trump talking about budget cuts all around that same time period, like late October. And it caused defense was painful to own last Q4. But then year to date, we've really seen it rip. I think our defense names are up, 30, 40% year to date already. And we added to them in January because we said our thesis hasn't changed. Defense spending is going to continue to increase. There's some near-term volatility created by policy uncertainty, but it gave us an opportunity to add to some positions that we'd been looking at and waiting to add to. And we have a full defense playbook if you want to see some of our favorite names. And you can also just look up, the PLCY on Bloomberg and see our names that we own in defense too. So infrastructure spending, I said we put odds at 100%. Infrastructure is being driven by states. And we've seen it since 2013, 29 states have increased fuel taxes. And really, use of proceeds is to go to infrastructure spending. So we expect states to continue, even this year we saw Alabama and Arkansas, continue, and Illinois is talking about, I don't know if they passed that or not, but vehicle registration tax increases to capture electric vehicles as well. But again, fuel taxes to pay for bridges, pay for roads, transportation infrastructure. It's just starting to show up in the names. Again, these names are starting to get legs right now. I still think it's a pretty attractive time for infrastructure. And you can, again, see our favorite names in the infrastructure playbook there, too. But yeah, I'd be looking out for management teams, especially in October, talking about their Q3 earnings. I think infrastructure is still really well positioned for the next couple of years, actually. So cannabis is interesting. Obviously, a lot of people are talking about it. How many people in here have clients or somebody who's asked them or pitched even a cannabis investment? That's the best showing of hands I've got so far. So a lot of activity out there, right? I've been pitched on it more than I've been pitched on anything. I don't know if it's because we relocated to California or what, but that's certainly been something that people are trying to pitch. And we're seeing really interesting structures, and by interesting I mean bad. And the thing about cannabis, like our base thesis, is what happens when it goes from medical, which are these kind of up here, we're talking like $2,000 to $3,000 a pound, wholesale price, and then it goes recreational. And we see really kind of the floodgates opened. You have individuals who are allowed to grow it, you have an explosion of kind of industrial scale type growing, and what that does is it immediately compresses supply chain, margins and pricing. And so you see prices drop precipitously within 1 year of legalization. Oregon and Washington went down 50 and 65%. And that just continues. I mean, we think we're heading from $600 to $100 eventually. This is a cash crop that can be grown in 3 to 4 months from planting to harvesting to production to end market. And so there's really 0 barriers to entry, very low. And then also our concern is that tobacco comes in when it is legalized, or if it's legalized at the federal level, that tobacco comes in, big tobacco, and they effectively have 0 incremental cost to bring in capacity, right? They can just shut some tobacco capacity, bring cannabis through that same supply chain, and really wreck industry margins. Because they're the most efficient at it, they get how to grow a smokable crop and distribute it and market it. And so we're really concerned about that. And from a policy standpoint, yes, there's a policy trend for legalization at the state level. We just saw the SAFE Act pass the House yesterday, and it was overwhelmingly passed. I think there were 90 Republicans who voted on it. So it was 321 to 103 or something like that. It was a big passage, and it was stronger than we expected. So the SAFE Act is the banking act for federal banking, saying, okay, if states have legalized it, they're allowed to access federal banks for cannabis. And so it's a big step, and we think the Senate actually might vote yes on it, and it might see Trump's desk before year end, which is an interesting step. The really kind of irony in it, though, is that vote actually delays federal legalization, because this is kind of the one hurdle at the federal level they need to get out of the way, and then a full federal legalization is probably longer, pushed off even further because of this. So that's something that people aren't really talking about or thinking about, and we can talk more about that after. But so like the biggest hurdles are like taxing and regulating cannabis, the employer concerns about liability and drug testing for cannabis, and then monitoring for DUIs, and then the federally insured banking. So it looks like we might get that banking hurdle cleared, but there's still a lot of big hurdles to overcome at the federal level before we expect legalization. Just a side note, the way we're playing it is through tobacco. I mean, tobacco names have gotten beaten up recently. They're beaten up at the beginning of the year. We started adding to them. They're still kind of interesting. So the way we're playing it, if there is a play, in tobacco, the primary thesis is FDA fears are causing too much pain in tobacco stocks. So that was what our primary thesis, but the secondary thesis on our tobacco names is that if there is a legalization of cannabis at a federal level, the tobacco names are there to play that. And then just one last one that's worked really well year to date is Avalara. They IPO'd about 13 months ago. It was August 2018. IPO'd at $24. Stock is now hovering around $80. Got up as high as 90. And what this company does is they are sales tax compliance software. So the Supreme Court ruled on what they call the Wayfair decision or Wayfair ruling, and that's Wayfair.com, the online retailer for home goods, home furnishings. And what it was states used to not have to collect sales tax at that state where the sale was made. If you remember Amazon in the early days, right? You didn't see the sales tax ever show up on your bill or invoice on your receipt. And the Supreme Court ruled that was actually illegal. So if I'm buying something in St. Louis and Amazon shipping it to me from wherever, Illinois or wherever they're shipping from, I have to pay Missouri state sales tax on that. And because of this ruling, it created a very patchwork of regulations at the state level they said, oh yeah, you definitely have to pay a sales tax, right? The states want that tax revenue. But the compliance for the e-commerce companies was very challenging. Avalara had been seeing this coming for 10 years. They had the product. They were ready to go. They're one of the only ones with this suite of state sales tax compliance, and the stock is reflecting that huge growth opportunity that's been created from that. So this is one we actually still like. We added a little bit to it recently. I think we added it right in January, bought some more in April, bought some more like here, but yeah, that wasn't the whole position. So yeah, we've been adding to this name throughout, and we still are pretty convicted here. So I want to touch on just 5 themes for 2020 that I think you could start positioning for now. And that's what we want to call out, is helping you position going forward and think about where there's a trend underway that's maybe not being reflected in fundamentals yet, or maybe not being reflected in prices yet. And so this is kind of our dashboard where we're looking at the top 20 policy themes that we monitor pretty closely. We monitor typically 25 to 30 on average, but these are the top 20 with the most activity, most action. Freddie, Fannie up top, and you all will get a copy of this presentation. Don't try to strain your eyes right now. You can look through this later or email me. I can give you a copy too. But like Space Force, Freddie, Fannie, Uranium, kind of some of the more overbought. E-cigarette, education, cannabis are some of the more oversold. This is on a 50-day moving average, so it's a pretty short-term indicator, but interesting to look at. And we always like to look at those short-term sentiment indicators for entry and exit because they are pretty powerful, and we'll see an example of that coming soon. So I'm going to talk about the 5 policy themes for 2020. Sports betting, we're at the beginning of a multi-year trend here. We think we're only in the second, third inning of sports betting being legalized at the state level. And reason being, you have a state legalizing it, the state next door wants to legalize it too right away because they're going to miss out on that tax revenue if they don't. So we're seeing that trend really pick up on sports betting, legalizing that. Create some opportunities for casino traffic and the gaming technology. Not necessarily the sports book creating a bunch of revenue or earnings for them. It's more so the traffic and getting a younger audience in there. IMO 2020, that's the International Maritime Organization. This is new low sulfur fuel standards for maritime shipping. So bunker fuel, ship fuel, is going from a 3.5% to a 0.5% sulfur standard, which is a major change. And the industry is not really ready for it. They didn't ever think it was coming. So there are only a few who have newer fleets or who really understood that it was coming, better information, I guess, who are ready for it. And those are the ones positioned to outperform, and those are the ones we're looking at. Renewable fuels, I guess I should probably call it more clean energy because I threw uranium on there. But that's ethanol. EPA just ruled that ethanol, E85, can be produced year-round now. That's a big change. They used to not allow it to be produced in summer months because of pollution. This is a big change causing the boom for the ethanol names just the past 6 weeks. Media deregulation, this is an FCC action. Again, agencies driving this. EPA I just talked about. FCC driving the media deregulation. Local TV stations we think are attractive. And then 5G telecom. Again, another beginning of a multi-year trend here that is very much supported by the FCC and the White House. So we're going to look at some ways to play 5G. So talking about sports betting, there's a lot of text on here. I'll just summarize it for you. And just so you understand how these charts work too, this is a 50-day moving average line, the white line. And then on the other side of it is 2 standard deviations and up above and below. And so when it kind of drifts in the red territory, that's kind of a near-term overbought. It drifts into green, near-term oversold. Okay, so sports betting kind of was really oversold. We added to it heavily in August right here, kind of when it got to near-term oversold. We've been waiting for that entry point. But still pretty attractive on a long-term basis, we think, at sports betting names. And so really the thesis is it's not the sports book per se. Because if you look at MGM, for example, MGM has the biggest sports book in the world. They're doing 30 million EBITDA. It's like nothing for their 2 billion overall EBITDA. So it's not necessarily a sports book, but what it does is it brings in a younger generation, brings in more foot traffic, particularly the regional casinos. You know, you get some college kids in there who are going to gamble at the Pens and the Churchill Down type facilities, but it brings them in there. You're going to place a bet maybe, you're going to go roll some dice or play a hand of cards, and you're going to get a drink and a burger. And that's just all margin for the casinos. So we're seeing that it kind of reinvigorated traffic into the casinos right at a time when they need it. And so we think there's still good value there in some of the regionals and the tech companies who are enabling growth. So the tech side of it is more the companies who create games or do the enablement for collecting, commissions or enabling sports betting on mobile apps. Those are the names that we're playing for sports betting. And again, if you want to see any of these names that we actually own, because we do put our money where our mouth is, it's EventSharesFunds.com. That's the fund site. You can actually see what we're owning in these. Or if you email me, I can send you the most recent holdings by theme. But again, it's a multi-year impact here on sports betting, where we're going to see, I think, more and more states across the U.S. over the next few years, and it's just going to be, we think, a positive tailwind for these gaming companies and tech companies. So I mentioned IMO 2020. That's, again, the International Maritime. We're going 3.5% sulfur to 0.5%. The last place on Earth where you can burn dirty fuel is over the ocean. And we have the G20 nations and then some who have come together with this IMO, this International Maritime Organization, and said we're going to drop to the low sulfur fuel standard. So all of a sudden the industry is going from 3.5% sulfur to 0.5%. You're going from a dirty fuel to something that competes with diesel, over-the-road diesel, and jet fuel. And that's a problem. Now the refiners are good at adapting, so I think the refiners will figure out how to crack the slate pretty quickly. It'll be kind of first 6 months of the year. There'll be some fits and starts, but I think the refiners will figure out the balance. The shippers, on the other hand, they have to take capacity out. They have to take their boats and dry dock them, or at least take them offline to put these scrubbers on. And the scrubbers clean the particulate matter that's coming out of the exhaust. And what that's doing is it's going to take capacity out of the system right when the shipping industry could use a little shot in the arm. On the flip side, the companies who are newer fleets or have already installed scrubbers can keep burning that dirty fuel. And that's where you're going to double margin benefit, where like a Scorpio Tankers, for example, is going to get a margin benefit from being able to buy this low-cost fuel that nobody's going to want anymore other than China. And then their competitors are going to have to take capacity out, so they're going to pick up business from that. Pricing is going to go up. It's a really good tailwind, confluence of tailwinds, yeah.
What's the timeline and cost to take a tanker off and sell scrubbers?
Yeah, it varies by the ship size pretty widely, but I think from what I've read, it's a few months. And they got to bring it in, and they got to get, they have to make sure the scrubbers are there, so they got to pre-order. Liquitech's an interesting one that I can't buy in the fund because it's too small cap, LIQT. I own it personally because they make scrubbers. And they've gotten, that stock's still, I think, a really good value. But yeah, it's a few months coming offline, but you're going to have like 10% of the capacity of the industry kind of coming off all within the first few months of the year. And they're already seeing some come out, and you're seeing that reflected in rates already just the past month. So people are starting to prepare for this, and they're already taking stuff out, so they're ready for 2020 compliance. Again, it's a multi-year impact. This is one where, again, I think the refiners are going to adjust. We're playing some of the refiners who are better slated to help crack this new crude. So we're playing a couple of those as well, but really the shippers are where we're playing it. Those with newer fleets, those with scrubbers already installed. We think they're just going to get a really good tailwind from this. And the industry's at a cyclical bear market too. Seems to always be, if anyone's ever invested in shipping in here. But we're at a point now where there's a lot of tailwinds all coming together, a pretty good confluence of tailwinds. So really like some of these names. On renewable fuels, this is one, if you look at short term, there was an opportunity really last month to get in here, and this is right when the EPA ruling came out. And then they've just ripped, slowed back a little, but even long term, these are really interesting names to get in. And this is effectively our little mini index, right, of these ethanol and clean energy names. Like tickers Reggie, for example, GPRE, another example. But the ethanol going to year-round is a big deal. This is going to create more production of ethanol, more demand for ethanol, we think, given there's more consistency in supply, and it's a tailwind for the ethanol producers. You know, the refiners actually surprisingly somehow got caught up in this. There's this negative sentiment from the RIN waivers, these renewable energy credits that refiners have to use or buy in order to offset some of their carbon footprint. But it's created an opportunity for some of the smaller refiners, you know, where you're seeing kind of some mispricing there, some opportunities in small refiners. So if you're in that space, take a look, because there's some opportunities in that. And then uranium, I mentioned, not a renewable energy, but it's a fairly clean energy. And the Section 232 study has cleared the way. We're going to see the final committee on the Section 232 study. And if you recall, Section 232 is national defense. It's one of the best uses we've seen of this Section 232 so far was uranium, but Trump said in July, not going to do anything here, not a national security threat, which was interesting. So we're going to see next month the kind of final ruling from that uranium committee, which Trump's administration is a part of. We're going to see kind of final word, but what that's done is it's cleared the deck. So uranium market was really not functioning appropriately. The spot market was a disaster. Long-term contract market effectively went away. And now we're at a point where uranium is starting to stabilize, and we think we're going to see a secular recovery followed by the secular growth that's there. We got China and India effectively building 50 new reactors over the next decade, and those are all going to be uranium-based production. So that's going to be a big tailwind. There's not enough supply there in the industry. The industry is like significantly undersupplied for all 50 of those reactors. So a good long-term tailwind in some uranium. The only name we play there is CCJ Chemical. They're a Canadian producer who sell a lot to the US, but also global. And you'll see kind of the sentiment picked up after that ruling. It just cleared the way. But now we're kind of getting a little pullback here just with the rest of the market, really. So media deregulation is interesting because it's FCC-led. FCC every 4 years meets and determines market consolidation rules. They say, okay, if you're a local broadcaster, you can't own the Fox, the NBC, and the ABC all in one market, right? Because you're effectively controlling the local broadcast market. That's what the FCC has traditionally done. They've limited it pretty dramatically. The most recent review, the FCC has communicated that they're viewing the streaming companies as threats to local broadcast. And so the Amazons, the Hulus, the Netflixes out there, they're viewing that as taking share from local media and saying that local broadcast now is competing with them. And what they're doing is they're relaxing the local broadcast ownership rules, which we think leads to industry consolidation, which leads to better pricing power and better negotiating leverage with the broadcasters. So we think they're going to be able to consolidate, drive up retransmission fees, and drive up their overall profitability. So that's something, and you know, I'd love to debate this with a media analyst in here because it's something we're pretty convicted in, but it's a fascinating trend we're seeing that we're going to see, we think, more consolidation at the local media level, and people are pretty much throwing these stocks away these days. So some value opportunities there if you're a more value-oriented investor. And I think a really good entry point both on the short term and long term for these names, I will say, just in my opinion. 5G, if we've seen a lot about this, so the 5th generation of wireless telecom. The one thing you should know about 5G, well, not only that it increases speeds 10 to 100x, so you're going to be able to stream from your phone, 4K quality. You're going to be able to access internet on your phone just like you're plugged into your fiber at home. It's going to be that fast. The latency is going to cut to nothing. So you're going to feel like you're streaming on fiber, but you're going to be getting it from your phone. What that requires, though, from a system standpoint, from a capacity upgrade standpoint, we have to put nodes, the industry, and we have to put nodes on pretty much every 4th telephone pole. You can think of it as like a Wi-Fi router. It's a much denser network, and it requires a lot more investment of equipment and a big rollout. And so who's going to be there? Well, the names that we like American Tower, they're one of the REITs, and CCI as well. They own the cell towers, but they're going to be the equipment managers. They're going to be the ones managing those telephone poles, what's on top, the assets on top. They're going to be the ones getting, leasing out more space on their towers to the Verizons and the AT&Ts and the other telecom companies. So we like those a lot. Ericsson, SBA, Nokia, Ciena, Unity to a lesser extent, these are equipment companies who are there at the sweet spot. You'll see what's not on the list is semiconductor names who have China exposure, large China exposure, and that's intentional. We want to avoid the Chinese exposure because we think a prolonged trade battle, even if we see a mini deal or any of this, and we can get into this in Q&A, but we see really nothing happening until 2021 with China. That's material. And so we want to just generally avoid China-exposed semiconductor names, even if they have 5G exposure. So that's why you won't see those on the list. And then like Wi-Fi. So Boingo, you probably see their networks, in airports and stadiums, public places. They are really good. They understand that densification. They understand how far each node needs to be. They really get 5G already, even though people don't recognize them for that. So that's a really interesting play too. And again, I think kind of just a decent entry point from a longer term perspective too. This is going to be a multi-year secular trend supported by government policy, the FCC, deregulating spectrum, and the White House pushing for Western equipment. So this is our policy tracker. And the policy trackers, you can think of it as our watch list. We put this out there and disseminate it to the public because we want people to understand there are so many different areas of the market being impacted by policy, and we cut it down all the way to the single stock level. So this is something you can download on our website. It's updated a few times a year, and it's our most popular piece. And I just want to put it up there. You're not going to be able to read this, but I would say if you're interested, check it out. It's on EventShares.com. And how I mentioned, we put our money where our mouth is. This is where we're actually investing, and the percentage allocation to each one of these themes, rough approximation of where we're allocating. But 5G telecom up top, 14% roughly, infrastructure 12%, IMO 2020 12%, defense 11, health tech 10, sports betting 8, renewables 8. And then it goes down into some of the smaller ones, local media 4. That's just because the opportunity set in local broadcasters is, there's only so many names you can own there, I think 4. And then you see some of the rest. But we are using our research that we're sharing out there with the public. We're using that research to inform our investment decision-making process. And we're putting, we're allocating the capital to the best ideas in our view. And we have a policy scoring process that's fundamental and policy-based 50-50 that drives these weightings. So it is very systematic on how we're weighting it, even though it's an active process. So just touching one last time on just the policy, not politics. What is the benefit of policy? Well, it adds diversification. We see it consistently in what we're managing, but even just thinking about policy and your overall investment thesis or asset allocation can add diversification because they're different drivers than traditional economic drivers. And I think people tend to marry them, and they actually are somewhat independent. So it complements that traditional tilt versus growth, quality, equity versus fixed income, and the like. The differentiated exposure, again, it's thematic exposure, it's multi-thematic. So you're getting different drivers of the portfolio, which we think are really important in different drivers coming from policy. And then client experience. I had, a colleague this morning who I was meeting with mentioned, clients don't want to hear about large cap value necessarily. They like stories still. Even if you're not going to implement that story, they still like to hear investment ideas. They'd like to hear themes. And so that this type of theme, this multi-thematic, tends to resonate is what we've been told. So just hitting on the 10 investable themes, and because I threw on a bonus here because I think it's important to call out because I didn't touch on it. But we talked about defense spending, recession-proof or recession resistance. Infrastructure is states. Cannabis, long time for full federal approval. Sales tax compliant, we called out Avalera. Sports betting, the casino traffic play, and some of the tech companies related. IMO 2020, it is going to be disruptive. Not enough people are even aware of it. Renewable fuels, we got like the ethanol, we like a little uranium there that's not really renewable, but a cleaner fuel. And then media deregulation, the local TV stations are how we like to play that. Uranium, CCJ is our only play, but it's kind of the restart of the cycle right now with a good secular trend behind it. And then the last piece I added was just healthcare. I didn't touch on this, but managed care we think is facing a very low probability of single payer, and healthcare is the most under-owned it's been in years right now. So take a look at some healthcare. We think in the next 6 months is going to be time to start thinking about that. I think people are worried about Elizabeth Warren and what that means. Again, there's very little appetite for single payer on both sides of the aisle currently. We see almost no possibility it gets through Senate, even if Senate flips Dems. So again, creating some opportunities, policy fear, creating some opportunities in healthcare right now, particularly managed care. So that's it as far as the policy. I want to touch on just market desk briefly because I think it could help some people in here. In the genesis of it, I mentioned was people were telling us, we love your policy work. It's really good. It's visually stimulating. It's very easy to digest. It's clear-cut ideas, idea generation. Can you broaden that out to broad markets? And so that's what Market Desk is. We just launched it this month. You are the first people really seeing it in a group setting at all. It's been kind of just soft previewed with some close friends. But what it is giving you a daily, a weekly, a bi-weekly top 10 ETF and then a mid-month macro, and then some others. We do the idea screens, which are more for stock pickers, and then we do the thematics, which are more for people who want to do thematic investing, and we call out individual stocks in there too. So we have an IMO 2020 and a media deregulation thematic up there on the site. But again, we're trying to be the vanguard of research here. So what we're doing is for a single seat, it's $995 a year, and for a team of 5, it's $2,700 a year. A team of 10 is less than $5,000 a year. So it's really trying to provide very high quality research at a very affordable price, but actually give you actionable insights. So the top 10 ETFs, again, you can download all these on marketdeskresearch.com. You can get samples of each one of these reports, and they just launched. They're pretty fresh. So I would check those out if you're interested in something like this, and any of them. The weekly is really the flagship document. But in the top 10 ETFs, we look through to the ETF holdings, which a lot of people don't do this level of analysis. Maybe Eric Balchunas at Bloomberg does some type of analysis like this, but we're looking through and looking at the fundamental trends of the companies that are in that ETF. We're seeing earnings revisions in this, in a certain ETF, and we're calling that out. We're seeing a lot of earnings upgrades, and that's going to drive, we think, these names. And so we're looking where there's a concentration of those names held in an ETF, and that's how we're getting a lot of ideas. This is healthcare. I mentioned, this is IHF. It's looking very attractive versus 5-year valuation, right? This is a really good value play. You're seeing 2 standard deviations below its 5-year average on PE. And so it's just calling out the sentiment of healthcare is really negative right now, but it's creating an opportunity from a value perspective. And I mentioned, fundamentally, we think there's very low probability. So these are the type of things we're calling out. FINX is we're seeing really big pickup in options, call options. So it's bullish trend. There's a lot of option activity on here on the call option side. So outsized buying, outsized long positions in fintech. So interesting to see that. So that's the type of things we're calling out. Idea screens, we have 45 different screens, each with a whole page of stocks on them, but you can see the returns kind of by theme. Again, these are all on the website. I would just encourage you to look at it if you want to see it. This is an example of next 12 months EPS, just kind of seeing what one of the screens looks like. So there's 45 pages that look like that. But again, more for single stock pickers. And so what I wanted to mention, and my partners told me I could do this, so hopefully I don't catch too much flack, but they said for anybody who's St. Louis CFA Society member at this lunch today, they'll give 30% off for a first-year research subscription if they sign up before October 1st or by October 1st. So let's say by October 1st. So if you get in before October 1st or on October 1st, you'll get 30% off this, and then 15% off if you do it before Q4 ends, so before year end. And we just wanted to say, thank you for giving us some feedback on this. Thank you for listening to it. We'd love to hear your feedback after you get in some of the reports. And our thank you is just giving you a discount on your first year subscription if you could do that. So you just email me or submit the form on the website and just put STLCFA in the notes or the subject line. But that's it. Happy to take any questions. Thank you for listening to the policy. I hope it is informative. And I want to answer any questions you have.